morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah. You're watching Indian Open. Let's go straight to the headlines at this hour. A Fed rate hike is coming in June and more or less a given. Show minutes of the last FOMC meet. The US central bank is also comfortable with inflation staying marginally above the trajectory. The US administration is considering trade barriers on vehicle and auto part imports, something that could hurt Indian auto component manufacturers as well. Higher sales could not cushion Tata Motors' performance in the fourth quarter. Profit halves. And Jet Airways auditors raise concerns over its cash flow after the airline posts a big loss in the fourth quarter. Good morning, viewers, and it seems to be a flattish start to the trading day. That's what the Asian markets seem to indicate, though Nikkei is on a bit of a fall, up down about 1%. The US markets were okay. What happened overnight, though, was interesting. The US Federal Reserve is on track to hike rates in June, officials say. They would welcome a modest overshoot of their 2% inflation target as well, but they stopped short of hinting at a faster pace of hikes. First up, Kathleen Hayes of Bloomberg News reports.
I'd say the top of the list is the sentence where the Federal Open Market Committee, the FOMC, basically makes it look like a slam dunk. It's a sealed deal. There will be a June rate hike. Let's read the exact words of what they said. Most participants, that means there was probably only Jim Bullard from the St. Louis Fed, who doesn't think the Fed should be hiking rates at all, agreed or judged that if incoming information broadly confirmed their current economic outlook, strong labor market, more investment, fiscal stimulus coming, it would likely soon be appropriate for the committee to take another step in removing policy accommodation. Now, the other thing so interesting, and another sentence that people took a lot of meaning from, is the one where they say in the minutes what they've said publicly. They're really not declaring victory on inflation yet, even though it has just now touched 2% on the key measure for 1 month. Here's what they said. It was also noted that a temporary period of inflation modestly above 2% would be consistent with the committee's symmetric inflation objective, could be helpful in anchoring longer-run expectations at a level consistent with that objective. Sounds dovish, doesn't it? Because they're actually going to say it's helpful to have inflation above target after it's been so long. People said this was dovish. Bloomberg Economics says Jay Powell, the Fed chair, is probably in the 3-rate hike camp. No mention of emerging markets. That's interesting. Seeing what we've seen in Turkey having to boost their key rate by 300 basis points to support a plunging currency. Their president, Erdogan, opposing these kinds of moves. That's the kind of thing that if it were to spread into emerging markets more broadly, maybe the Fed would take notice, Betty. But for right now, much more focus on inflation. Not a problem if it's starting to rise. Positive on growth, but no sign the Fed's in a hurry to go from 3 hikes this year to 4.
Not in a hurry, but June seems to be a certainty. Any implications of that, as also what's happening across the world as well? Turkey, remember, has hiked rates as well in a bit of a surprise move too. Let's talk about all of that with Seth Freeman. He's Senior MD of Grass Ratner Advisory and Capital Group. Joins us right now on the phone line. Seth, good having you. Thanks so much for joining in. What do you make of the Fed minutes? Par for the course and on expected lines, or did you believe that there were some surprises here and there?
Oh, I think it was pretty much par for the course. You know, I think they're very comfortable with the fact that we are achieving, in some ways, perhaps unfortunately, this 2% target inflation rate, and keeping their eye at the same time a little more, I think, on the global situation than previous years. Yeah.
They sounded fairly okay with inflation staying above their target rate as well. In fact, on one of the Bloomberg reports I read, it said that the Fed would in fact be comfortable and happy if indeed the inflation overshoots their target rate and stays above that for a particular period of time.
Yeah, that's actually pretty much I think what they said in the last statement as well, and I think that's sort of a guidance point, and why I think a lot of economists believe we're still looking at only 3 increases this year.
Seth, one question, what does all of this, I mean, yes, the Fed hasn't given a surprise, but what's happening across the world is interesting. One, the dollar strength against a host of emerging market currencies, including India. The Indian rupee, for example, has slid to lowest level since November 2016. Turkey's had this very interesting rate action as well, done overnight. What does all of this mean for emerging market equities and bonds as well?
Well, I think for those countries that are net oil importers, like India, that there's going to be quite a lot of impact between the rise in oil prices and the strengthening of the dollar. It's sort of a double whammy for countries like India. Conversely, frankly, for emerging markets investors whose portfolios are priced in dollars, it's negative because of for example, the foreign currency depreciation.
No, which is a fair point, and therefore my question, Paul, say if we take India for example, Seth, we haven't really had dramatic dollar inflows into India in calendar year 18, save for a month maybe. By and large, FIIs have been net sellers. With the positions the way they are standing right now, do you think there could be heightened flows out of even stronger markets like India into the developed markets?
I think whether it matters whether we're discussing equities versus debt, and of course with higher rates outside of it, rates going up in developed markets, that's going to put some pressure because the premium for investing in India is less attractive, on debt. But for equities, I think we're in better shape than usual, partly because of so much index-based investing and the fact that, investors, I think, are going to stay in equities for some time. And so whatever allocations there are to India and other emerging markets countries are going to be buffered because of the index.
Seth, we'll leave it at that. Thank you so much for taking this call. Appreciate your time.
Thank you.
That's Seth Freeman with his thoughts. By the way, keep in mind, that's not all. Paul Krugman is joining a growing contingent of economists and money managers from across the world in warning of a meltdown in emerging markets. This story is there on the site, and it's for everybody to go out and see. I think the important point that he's trying to make is that until now, he didn't find a hint of a crisis on the horizon, but he can't say that anymore. He's drawing a reference to a global financial crisis kind of performance in the emerging markets, but he's saying that while it's not doomsday situation as yet, there are hints of a doomsday situation coming in. I wouldn't want to spell more about this, but this is one more voice in addition to Mark Mobius as well, who you heard on Bloomberg Global all through the last week as well, saying that emerging markets are looking particularly difficult to invest into right now. There is a high likelihood of these markets coming off. Let's see if they do, but certainly the situation from a lot of global money managers seems to be scary. In fact, just a quick check on the trade setup as well before we move to the first word for the day. Yesterday, we were all hoping that what we saw in trade day before yesterday and some bit of uptick would continue, but the frontline indices resumed struggle in yesterday's session. There was distribution. The Nifty breached the 50-day moving average yet again. If you just look at the charts, it's happened multiple times, but in yesterday's session, key levels 10,500 broken. So on the options activity, that was a good one. That was an important one, and the 50-day moving average also broken through in trade yesterday. All of this doesn't augur too well. And by the way, it wasn't really too many heavyweights which came off. Metals, for example, 5, 6, 7% cuts that came in for the metal names. Smaller indices like media, real estate came off, and all marketing companies, we all know what they are doing. The struggle continues there. HPCL, in fact, is at 52-week lows. And if you just look at what these stocks have done over the last maybe 4 or 5 or 6 odd months, from the 52-week highs that they were at, HPCL is down 41%. IOC, BPCL 32 and 31%. This is despite the fact that they've been able to hike petrol and diesel prices for 12 days in a row. It's seemingly unprecedented, so to say, and despite all of these, the stocks are down and out, so there's a clear scare out there on a bunch of these indices and bunch of these stocks. And by the way, if we can just revisit that RSI, okay, one, the rupee, which has also slipped to its lowest level since November 2016, is an important one. But if we can just go back to the RSI chart, and if you look at the lower panel, the index is still some points away from being in the oversold zones. The lower panel is the one which highlights whether the index is overbought or oversold. We are not close to the oversold zone as yet. So for people who might be thinking we might be at those levels, well, clearly we are not. That's the index, and doesn't look like there is a lot of positive to take home from, but for the fact that the SGX Nifty is hinting towards a positive start. Let's wait and watch. Stocks to monitor today, slightly late on that, but let's have a look at 2 or 3 of those before we move to first word. Jet Airways, and we'll speak at length about it, but there's a net loss, margins negative, EBITDA negative, should react in the session today. Well, has already reacted quite a bit, down 50% from the highs. There's some strong numbers. Eros International Media, margins were exceptional, 38% versus 22%. So exceptional growth on the top line, bottom line, and the EBITDA front. Similarly, Natco Pharma, in a quarter where we are hungry for good news from the pharma companies, Natco Pharma delivered a very strong quarter, 36%, 69% jump in PAT, margins at 49.9% versus 42.7%. So all in all, seemed to be a good quarter. There were good results from other companies like PNC Infratech, Suntech Realty, Rupa for the matter, came out with a fairly good set of numbers. So watch out for all these names as well. And 2 interesting bulk deals. One, Kaveri Seeds, Pabra Investment Fund has bought about a 1.2% stake, small one, but they've bought in. And Indian Terrain Fashions has a fair bit of marquee investors. Now you add one more out there, Malabar India Fund, Sumit Nagar's fund has bought about 2.6% stake, though it's DSP BlackRock MF that has sold out. But Malabar India Fund, they weigh their purchases. It's an interesting one. Let's see if this one reacts in the session today or no. But that's not all. Lots more editorial stories, the important ones that get highlighted on First Word. Today on First Word, we sum up some of the concerns voiced by the Tata Motors management after their poor performance in the fourth quarter. Then Darshan will join us to tell us why Jet Airways auditor decided to prepare the financial statement as a going concern. And we talk about the possible impact of the various government decisions that could have on the oil and gas space, particularly the oil marketing companies. You know, normally I would have started off with Tata Motors, but Jet Airways, that's the other airline company that's had a very, very turbulent fourth quarter. The country's oldest private air carrier posted a surprise loss after factoring in a one-time maintenance charge and an impairment loss for subsidiary Jet Light. Darshan is here with the details to tell us, one, about the quarter, and two, about some very strong observations from the auditor, Darshan.
Yeah, so basically let's talk about the quarter. So basically what has happened is revenue, no doubt revenue is up, but it's the operational performance that is rather weak. Now if you're looking at the revenues were up almost 9%. They've done 5,900 crores. Net loss of 1,036 crores this time around, which means a negative margins at almost 3%. Now basically if you're looking at this loss that had happened of 1,036 crore, so after 11 straight quarters of profit, Jet Airways has posted a loss, and this loss alone has wiped out 6 quarters of profits that they've done. Basically, and the management, I'll come to what the auditor said, but the management also made in some observations. So what the management is saying, that the company has incurred a loss during the year, and now they have a negative net worth as of March 31st. They're saying that the loss and negative net worth may create uncertainties going ahead, but the company's taken various initiatives to improve operating performances, like cost saving, optimize revenue management opportunities, and enhancing ancillary revenues. Now, because of this statement, the auditors, what they have said is that the appropriateness of the assumption is dependent on the realization of these initiatives that they have said. So unless these happen, it is very difficult to ensure that something not wrong will something that probably may not go wrong, and their opinion is not modified in respect of this matter. Now basically there are 2 reasons why Jet Airways did so poorly this time around. First of all is the fuel expenses that have gone up significantly. So fuel expenses from 1,500 crores 1,580 crores last year, they've moved to almost 2,036 crores. So that's more than a 25% jump in fuel expenses, and also other expenses which includes their forex fluctuation, as well as provisions towards Jet Light, that has moved from 1,200 crores to almost 1,700 crores. So these are the two things that have taken a big toll as far as Jet Airways is concerned. So all the three jet airline companies have reported numbers till now. So what we're seeing is that despite for the full year FY18, Jet Airways reporting the highest revenues of almost 23,286, which is higher than Indigo's 23,000 crores. Indigo on one hand posted a profit of 2,200 crores. SpiceJet has 1/3 the revenues of Jet Airways, and they posted a profit of 566 crores. Jet Airways being the largest in terms of revenues, and they have posted a loss in excess of 1,000 crores. So clearly, despite all factors being same, I think operationally is where Jet Airways did mess up big time this time.
It has, and that is a problem for the stock, for a company that has gone down really over 50%. The last 3 months, 43%, YTD maybe northwards of 50%, and doesn't seem to be any relief inside. Darshan, thanks for putting that into perspective. That's not all though. It's not just Jet Airways which is under a cloud of bother. There is no relief for consumers, no relief for the oil and gas space as well, as fuel prices rise for 11th straight day. The government is under pressure to ease the burden, and OMC stocks have fallen on fears that they may have to take a margin hit. Now, what I've tried to do here is just put together a few factors that people should watch out for the oil marketing companies. It could well percolate to the overall oil and gas space, but I'm restricting my chat here to the oil marketing companies. They are off and off significantly over the last few days, weeks, months. 41% for HPCL, 32% cuts for IOC, 31% cut for BPCL. So it's not been a happy hunting ground for investors in this space. Now, yesterday, Ravi Shankar Prasad said that the government is in a process of finding a long-term structured solution to volatility of crude prices, and the revenue through excise used for building various forms of infrastructure, which to me reflected the government's disinclination to cut the excise duties, to be honest. It does seem from that comment that excise duty cuts, while the market is working with that possibility as well, may not be true. So what is it? The three scenarios that could happen. One, can the government cut the excise duty? Now, that is one simple solution. I think the opposition parties, knowing the weak position that the government is in, have been vying for this as well. But remember, a cut in excise duty really leads to a cut in revenue for the government, which is not something that they would be very, very keen to do. So that is scenario one, that the government cuts out the excise duty. Now, scenario two, which could be seen as a reform rollback, which is the government cuts the prices of petrol and diesel. Now, various news reports have suggested a possibility of 2 rupees to a 4 rupees cut in the prices of petrol and diesel. Now, what could this do? One, it is seen as a reform rollback, and the other option that the government has is that the reports have also suggested the government may ask the oil marketing companies to freeze prices as a temporary arrangement. Now, this is scenario two, and if the government goes down this path, then it could be well seen as a reform rollback. So this is the other part which a lot of market participants are hoping and believing that the government will not do. Scenario three, government urges upstream companies to share the subsidy burden. And remember, this bit was discontinued in 2015. Until then, for about 13 years, ONGC, Oil India had paid as much as 40% of the under-recoveries arising from the fuel retailers selling petrol, diesel, domestic LPG and kerosene. Now we just have LPG and kerosene out there. The main fuel items are not a part of this subsidy sharing mechanism. And if that is done, then it's a big negative for ONGC and Oil India. However, consequently, as a result of that, BP, HP, IOC could escape the wrath of investors. So scenario three from an OMC investor's perspective, or scenario one from an OMC investor's perspective, is probably a good scenario. What all of this has done though, in trade over the last few days, as I mentioned, the kind of cuts that we've seen in BP, HP, IOC, is that it has brought HP and IOC, at least the two who have reported their numbers, and now possible to figure out what they will do 1 year forward as well, at about 8.8 times 1 year forward P. Now, this is exactly in line with the average for the last 10 years. Look at that chart. I've borrowed it from a Motilal Oswal report, the 1 year forward P, and the yellow line is that 1 year forward P multiple. Over the last 10 years, the average P multiple for HPCL has been about 8.8 times. In bad times, of course, the multiples have gone down way lower, and in good times, we've seen the peaks that we've struck there. Now, the stock has come off from closer to the peaks, to the average on fears that the government may intervene. If that doesn't happen, then could there be a case of these stocks going up? Or the counter argument that with the erosion in the return ratios and this overhang of maybe cuts coming in, should one pay a premium multiple to a company like HPCL, BPCL, IOC, as the case may be? That's the big question, and a big question that will be answered only after the government makes its move on whether they cut the excise duty, whether they freeze prices or ask the OMCs to cut prices, or whether they ask the upstream companies to bear the subsidy burden. So this is something that we will watch out for in the next two sessions. Almost all political chatter seems to suggest that we'll have a decision within the next couple of days. So let's wait and watch. Could have a big bearing on what both the upstream and the downstream companies do. The last piece on First Word today, higher sales could not cushion Tata Motors' performance in the fourth quarter. The company's decision to shelve number of projects under various stages of development meant that it had to account for more than 1,200 crores in the last quarter, and the company is not too enthusiastic about the future either, especially for JLR. Right, Yatin?
Clearly, and this is probably one of those results wherein we have a lot of adjustments, a lot of one-offs. Of course, this time we had one-offs on both the sides, one which were boosting the profitability and one which were impacting the profitability. But let me talk about the consolidated earnings first, and the revenues. Despite seeing a 46% jump, we saw the overall weakness at the standalone level. Now, if you look at the loss, the standalone loss stood at 500 crores. The EBITDA margin for the standalone entity, the India entity, was nearly 5.6% for the quarter. If you look at the consolidated earnings, 18% revenue growth there, top line coming in over 91,000 crores. EBITDA also seen around a level of 11,250 crores. That probably met the street expectations, but look at the profitability, that was down nearly 50% to come in at 2,125 crores. Margins for the consolidated entity stood at 12.3% versus a level of 14%. We were expecting some bit of pressure on the margin, but almost 170 basis points decline is something which the market was not expecting. And clearly the culprit were both the standalone numbers as well as the JLR numbers. As I was mentioning, the standalone margins were expected at close to 8.5%. The delivery was 5.6%. And you look at JLR also, we were expecting margins to be in the range of 14.5%. And JLR delivered an EBITDA margin number of 12.2% this time. However, their revenues came in slightly above street expectations at 7.6 billion British pounds, up nearly 4%. But the management commentary is most important, which was quite weak. The management believes that the global market still remain challenging for JLR. UK and Europe, these are the two pieces for JLR which are large markets. They have not been doing well. Of course, there are two concerns. One is the diesel car issue, and the second is the Brexit issue, which has been weighing down on the demand as well as consumer sentiment. The company said that the US markets is slightly cyclical in nature at this point in time, and probably it will take time to get stabilized. China is probably the silver lining, which looks good. Of course, commodity costs also, the management spoke about it. The commodity costs are looking higher at this point in time. So clearly at this point in time, margins would remain pressure is what the management has hinted so far. In terms of brokerages, CLSA has cut the target price to a level of 295 versus a level of 330. They believe that the margin miss is there for both JLR as well as the India business, and they've cut the FY 19 to 20 period earnings per share by nearly 7 to 8% to factor in lower margins and lower volumes for JLR.
Well, let's wait and watch. The cheapest auto stock, which got a bit of a bounce the last couple of days because it slipped sub 300, could well have some pain going ahead as well. Just very quickly, Yatin, what are brokerages saying? Have you been able to take stock of that? One key or two key names. I think CLSA said that there is a problem. A couple of others said that they're going in the right direction. What is the near term for Tata Motors then?
See, Neeraj, clearly the management has been talking about a rosy picture every quarter. I was surprised that this time in the press release they didn't even mention the JLR, EBITDA margins. Usually they give a breakup of the JLR performance. This time in the press release they did not. Of course, later on in the presentation the details were given out. But the management is now talking about maintaining a EBIT margin range instead of focusing on the EBITDA margin front. They are now talking about a EBIT range, which is quite surprising. Clearly shows that there is pressure on the business. There is pressure on the margins. You don't know how will the trade war between US and China shape up. How will China really cut in the import duties on imported car, because that is one market which is probably saving Tata Motors in terms of the volume growth picture on an overall basis, because the demand there remains buoyant. Europe is uncertain, UK is uncertain, and brokerages, of course, given the valuations, given the correction, probably make a case for some upside. But most of them have cut earnings across 7 to 8%. The high has been probably 10-12% so far, the reports which have come in. But at this point in time, clearly the earnings have been a washout. FY18 has been a washout in terms of foreign exchange losses, foreign exchange management, as well as on the margin front, because they were phasing out old models, getting in new models. But even if you look at the first 3 months, Jan, Feb, March, there also we have not seen a significant improvement in the margin as expected by the markets.
Okay, some pain points for Tata Motors. Let's wait and watch what happens here. Thanks a lot for that, Yatin. Well, afraid that's all that we have on First Word for the day today. Unfortunately, a lot of pain points. There are some smaller companies that have come out with good numbers. I don't mean to sound all bearish, but the Qs really haven't been the best. A bit later on in the show, remember, we will talk about this very situation with Pradip Shah of IndAsia Fund Advisors. He calls a spade a spade. It would be interesting to get his views. We'll decode the Q4 earnings of TD Power Systems with Nikhil Kumar. He joins us on Bloomberg Quint Live. And of course, talk about the aviation space a bit later on in the show as well. But for now, take a break. Come back with full tilt towards the day's trade on the other side.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार, just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे,
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Emerge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Hi guys, we're completing 1 year of the mutual fund show on Bloomberg Quint. Take a look at all that we've done over the last 12 months.
Optically, nothing is cheap. Volatility is integral part of financial markets.
Prices change every microsecond and NAVs change every day.
I have been always suggesting that if you can be Kumbh Karna, invest today and go to sleep for next 14 years.
Join us on the next leg of our journey as we attempt to make the conversations even more meaningful on your favorite show, The Mutual Fund Show.
The Mutual Fund Show Anniversary Special, Wednesday 4 p.m. only on Bloomberg Quint.
Welcome back. You're watching Indian Open. Let's see how the Asian markets are faring at this point in time. We are looking at some weakness seeping in when it comes to the Nikkei and Shanghai. Hang Seng, on the other hand, trading marginally in the green, up as much as 0.3%. What does it mean for the SGX Nifty? Likely to open in the green as per indications at around 10,464. Let's take a look at what the derivatives market is suggesting in terms of the day forward. We have Navneet Saluja joining us to give us an idea. Good morning, Navneet.
Good morning, Agam. Well, the cues are definitely weak considering the sort of weakness that one has seen in the markets in the past few trading sessions. So for the Nifty May futures, they've been closing at a discount. No major fresh build-up was seen when it comes to the May futures, but pull up the Bank Nifty. That's going to be the one in focus today. As today is Thursday, you'll see the Bank Nifty weekly options expiry coming by. What's the range that you should watch out for? In terms of OI concentration, likely on the downside, 25,000 could be a big support, and on the upside, watch out for 25,800 for Bank Nifty futures. 7% build-up, suggesting there were some fresh shots being built up there in terms of index futures in yesterday's trade. And important to note, both Nifty, Bank Nifty futures are trading at a discount. That's not a great sign. Volatility definitely on the higher side. India Wix up 4% in yesterday's trade. In terms of put-call ratio, well, that's been declining. If you look at the Nifty PCR, that fell to levels of 1.18, and also for Bank Nifty, that continues to be below the level of 1. Yesterday's closing was 0.7. What is the reason that Nifty PCR is going down? Because there is more of call writing and put unwinding which is taking place. So if you look at 10,500, almost 18 lakh shares were added in terms of OI in yesterday's session, and unwinding seen for the 10,500 mark. This is telling you now the 10,500 put is the one actually where maximum OI concentration was on the put side. Now the open interest on both the call and the put side is just about the same, around 32 to 33 lakh shares. So for the May series, for the expiry, watch out for that mark of 10,500. In terms of institutions, well, FIs are continuing to build up fresh shots. As you can see, yesterday's data, 16,000 contracts were added, and now they are net short on the index futures. If you look at the index options data, no major action seen, but yet fresh positions were being added across the board, be it call long or put short. Almost 6,000 contracts were added there. Quickly, let me tell you which are the stock futures to keep an eye on. Jet Airways and Just Style, both of them are out of the F&O band. Let's see if there is any reaction which comes because of that. Otherwise, just watch it for stocks like Tata Steel. Commodity stocks were weak yesterday. Fresh shots were built 6% higher in terms of open interest. And the other one which can be in focus is IGL. In a weak market like yesterday's, you saw fresh longs being building up for this one. Back to you guys.
Well, came out with numbers. Let's wait and watch if this does react. And Navneet, thanks for putting that into perspective. Well, let's talk about all of these stocks and more with Parthiv Shah. He's director at TRACOM Stockbrokers. He joins us right now on the show, as always on a Thursday. Parthiv, so good having you. Thanks so much for taking the time out. There's just so much to chat about, Parthiv. Let's start off with Tata Motors, arguably the stock in focus. The numbers left a lot to be desired. The commentary ever so hopeful, as has been all the time. As an investor, what do you look at? The valuations which are at the trough, or the outlook which doesn't seem to be all gung-ho right now?
Good morning, Neeraj. Neeraj, on a lighter note, as an investor, the only thing I would look at is how much money is being made in my bank. Very frankly, I mean, at one point in time, I really thought that Tata Motors is a value buy. I think the valuations can't really get compressed, etc., etc. And at that point in time, I think a stock like Maruti was quoting at around 6,000 levels. Now from 6,000, we know that Maruti is at 8,000 levels. It even touched almost a high of 10,000. So I think if you go to see that investors are more concerned about, despite the valuation concerns in a stock like Maruti, they are more, I think, inclined towards what is the market share that they're going to maintain. And I think the run rate that they're showing and what returns they're going to eventually give. Tata Motors at 450, 400, 350, at all junctures, it's looked always like a good value stock. But when it comes to delivery, I think, yes, it's a big miss. And I think, no doubt, the biggest worry, I think, even if the domestic operations were to improve, the 40% business of JLR, which comes from the European markets and the UK markets, contracting by 20% is never ever a healthy sign. And always there's a worry because those markets also have the diesel vehicles which are being sold, whose I think volume growth is really very tepid. Despite, I think, the growth coming from the Chinese markets, which is to 20%, which is a more profitable market for JLR. I think overall, if you go to see, even if they were to transition from the diesel vehicles into the new age electrical hybrid vehicles, that's really going to take a lot of time. And the market, which serves 40% of their revenues, I think it's very difficult to recoup when there are other fierce competitors like BMW, Audi, etc. So the JLR story does not seem that it's going to really kind of take a V-shaped sort of a recovery within the next 1 year. So that's definitely going to keep the stock tepid. Talking about the domestic operations, yes, there is a lot of improvement. The new launches are picking up. The CV segment, they're doing good. But again, I think the entire argument about Tata Motors is not really going to be the domestic story. Even if they were to do well there, I think it's not going to be game-changing for the stock. Plus the new policy of capitalization that they've adopted, which is good for the long term, and maybe it's thanks to Chandra's new policy for all the group companies. I think that's in line with what the peers are doing, but that again is going to impact the JLR margins on the EBIT level by 100 basis points. So I think they're giving a guidance of 7 to 9% EBIT. Let's see what they deliver, but again, I think very tepid set of numbers, and I don't see the stock massively getting re-rated from here anytime soon.
Parthiv, good morning. I also want your view on the OMCs right now. If the carnage continues, what's going on and how are you viewing these big three companies?
Good morning, Tata. See, yes, we did, I think, discuss about the OMCs a couple of shows back, and that was the argument that whenever we are heading into any sort of elections, and especially with the oil prices on the boil, the currency depreciating almost daily, I think that is not a good combination for the OMCs. And many of these OMCs were, I think, re-rated massively thanks to the fact that at that point in time, one really thought that these OMCs are now like free companies, free to do whatever they want. But now I think if we go to see, yesterday there was some comments circulating that, the government might not be very aggressively be willing to cut on the excise duty. But I think the pressure would lie on the OMCs that they will not be able to kind of raise the prices. And that's where we saw many of these OMCs correcting very, very sharply. So yes, I think it's clear cut and avoid in terms of any sort of positions despite the recent derating in the OMCs. I would really avoid these companies as long as we get more clarity in terms of the currency stabilizing and the oil prices also cooling off.
Okay, hold that thought, Patil. We need to discuss a lot of earnings that came through last evening, as well as some big earnings that we can expect in today's day of trade as well. We once again have our research team joining us to give us an update. Good morning, guys, and thanks for joining me. I'm going to start off with the good numbers. Who's giving me the good ones?
That's me. All right, so Suntec Realty, while a revenue growth of 50% and net profit growth of 140% may look fantastic, that's more or less in line with expectations. But what has beat estimates is the operational performance. EBITDA growth of 59% led by newer bookings, so watch out for that name. Eros International Media also good set of numbers. Revenue growth of 32%, net profit is up by a stronger 79%, and EBITDA margins have moved up from about 21% to 38%. Similar trend coming in from SML Isuzu, where revenue growth was muted, but net profit jumped by 56%, led by a strong operational leverage, where EBITDA grew by 36%. Natco Pharma also this beat estimates with a revenue growth of 36%, net profit growth of 69%, and EBITDA margins expanding by nearly 700 basis points. PNC Infratech, again, revenues doubled to 759 crores. Net profit grew about threefold to 111 crores, and EBITDA margins came in at 21% versus 13.6%. Rupa and Company, again, good set of numbers. Revenue growth of 10%, net profit growth of a much higher 70%, and EBITDA margins expanded by 600 basis points. A lot of strong numbers coming in.
Right. And where did the weak numbers come from, Nikki?
So to begin with, I'm going to start off with Shipping Corp, where there was a muted top line growth that we saw, and also cost saving expenses that were the techniques. We saw higher operating expenses, which in turn impacted the bottom line as well as the operating performance of the company. We saw revenue up as much as 2%, net profit up by 174%. Now that's on account of the bump up. The bump up we've seen is account of the tax credit credit that we've seen in this quarter. EBITDA is down by 39% for this counter. Second in the list, we have Premier Explosives, where revenue is up by 15% year-on-year basis. Net profit has come down 70%. That's account of poor operating show. The poor operating show, EBITDA has come down 24% on account of higher raw material expenses and other expenses, which have weighed down on the performance of the company. GET&D is another weak set of number that we're tracking this morning. Revenue down by 32% for this counter. Net profit too has come down by as much as 40%, back on poor operational show. EBITDA is down as much as 89% for this counter. This is despite the tax credit that we're looking at, 54.2 crore that the company has reported a drop in its bottom line. And last, a set of disappointing numbers are coming in from Shalimar Paints, where the top line growth seems to be muted. If you look at the net losses, they have enlarged for the company. EBITDA losses also have widened for this company. This is on account of the poor show that we've seen on top line front, higher other operating expenses, along with the interest cost, which is weighed on the bottom line performance.
Right. Of course, we're also expecting earnings from GAIL. Darshan, what can we expect?
Yeah, so it will be rather muted because we are seeing just a 0.4% uptick as far as revenues are concerned. But profit is seen up 6% and EBITDA is seen up 9% because of higher realization and how crude has managed to move up. Overall, gas transmission volumes are seen down 1.4% and petchem volumes are seen down 10%. Now, basically, realization for the petchem segments are seen much higher. LPG segment will also be strong, led by higher realizations this time around. Higher other income is expected this time around, which will also come in and boost profits for the company. And petchem and LPG realizations to improve on account of higher crude prices. So expect a slightly better quarter from GAIL this time around. But overall, on the top line, it will be muted.
Right. Okay, we'll be watching out for that. Thanks, guys, for bringing us those details. But Parthiv, I'm going to take the case of Rupa Company ahead with you. We've had earnings from Lux Industries with strong earnings coming in, and it's the same for Rupa as well. We're expecting a steady quarter from Page Industries also tomorrow. Overall, if you consider how the stock prices have also done, they've actually bucked the trend despite the weak markets. What do you make of some of these underclothes companies, and can we expect more strength? And how are you looking at them when it comes to valuations?
Yeah, I think on a frank note, companies like Lux and Rupa, they have certainly taken a page from Page Industries in terms of what they've seen, that if you run the company with good corporate governance practice, you tend to show the best of the results, especially these companies did have a lot of checkered past in which the margins that they used to show were really always surprising. But post GST and post, I think, the regime where many of such promoters are looking to enhance their market caps by showing the right numbers, I think we are seeing all these companies reporting fantastic sales. And no doubt, I think these companies also have got massively re-rated. No doubt, I think Page Industry always will stay the leader. But again, I think we've seen that this segment has a lot of buzz. There are 3 or 4 max plays which investors can play on. It's a huge untapped market, and every quarter, if they can show such volume growth, respectable margin growth, and I think such numbers, then I think these valuations will tend to get justified. No doubt, I think on the face of it, they do look expensive, but the potential and the way they are spending on the branding part, and with GST, I think what advantage they are getting, because there was a set of a huge unorganized market in this segment. So I think definitely all these companies will tend to do well. And no doubt, I think there will be a valuation delta between likes of Page Industries vis-a-vis Rupa and Lux. But even Rupa and Lux, I think they are also aiming to go higher. And I'm quite confident that over the next 3 to 5 years, these companies will also deliver good returns.
Parthiv, just looking at the set of stocks which have come out with numbers overnight, I know Agam asked you about what's happening with Rupa and the others. I'm going to ask you about Jet Airways, and the question doesn't extend only to Jet Airways. They may have posted a loss, and the auditor's comments were very strict there, but the others too. Interglobe Aviation wasn't the best. SpiceJet, Ho-Hum. Is the price correction that we've seen already pricing in the negatives in a sector which is growing about 15-20% month on month? Or do you believe that crude, the way it is, does derail all of those positive arguments?
Yes, I would say that's a fantastic question. See, frankly, I think as per what we've understood in the aviation sector, the market won't revalue or kind of re-rate your company just on the basis of a high volume growth. That high volume growth has to follow up with good cash flow generation. and that's been a problem. Even if I have to look at Jet, no doubt, ever since we have been discussing aviation as a sector, I've always talked about avoiding Jet, because if I look into the cost metrics, they're the worst in the industry. Now, this quarter can be easily summed up with very high fuel cost, which is quite normal for Jet. The sensitivity analysis when one does for the oil prices towards these aviation companies, Jet falls the worst. They had forex losses, as you very rightly pointed out. Auditors are always complaining about the lack of ability of cash flow generation to sustain the operations. These are not really very healthy comments, and I think even despite the recent derating of the stock, I would still say Jet would be a clear-cut avoid. And with the crude prices the way they are hovering at, even a few couple of quarters would really derail the story in whatever aviation sector we have seen, especially for stocks like Jet. I think even if one wants to play this sector, thanks to the higher volume growth, we'll have to go in for more profitable companies. And at this juncture, I would still wait out on the sideline, wait for a bigger correction in stocks like Interglobe Aviation and SpiceJet, because at least in Interglobe Aviation, there is a story of their fleet getting replaced of the Airbus Neo jets, which can be 15% more fuel efficient. So at least they are the cost leaders at this juncture, maintaining their market share. And these are the metrics that one would like to invest in when one is investing in an aviation stock. But yes, with the oil prices hovering the way they are, and intensive price competition in terms of the airfares, I would still wait on the sideline, wait for better entry points. I'm quite confident you might end up getting to invest into Interglobe Aviation, maybe 5-10% lower from the current market price. That will be a good entry point.
You know, pharma has been all over the place, Parthiv, but Natco, a very good quarter, and it's arguably been one of those companies that had withstood relatively the selling pressure that's come about in the pharma space, and the numbers are probably testimony to that. For somebody who's holding Natco Pharma in his or her portfolio, what would your advice be after looking at what they've done in Q4, which is arguably strong, and for FY18?
This is all thanks to the very differentiated business model that Natco Pharma brings along with itself. I think hats off and to the credibility of the promoters. I think this is not a company which is always chasing to show a very big top line, as some quarters of very big top line growth and then some quarters of subdued growth. I think this is a company which has a very differentiated strategy where they challenge the innovators, and I think they do spend some legal cost in challenging that. Once they have won that, I think they tend to earn fantastic margins on the drugs that they sell, especially the ones that they have challenged for the innovators and won. Case in point being drugs like Copaxone, etc. And I think they have a very, very strong pipeline. This as a company, I think, is really at this juncture, the way they're showing the numbers, I think they're definitely more immune as compared to many of their peers who are struggling to get their pricing power in US and European markets. So I think Natco Pharma is certainly hold for people who are holding it. Yes, because I think the entire sector is not in the limelight. We might not see Natco getting massively re-rated from here. But yes, I think this stock, at least at this juncture, unless and until there is some negative news in terms of any of its plants, etc., I don't see a reason why it will even derate value for its existing shareholders. So certainly a hold over the next 3 to 5 years. A lot of good pipeline can pan out, which can really massively re-rate this story in this Natco Pharma.
Okay, let's take stock of what the charts are telling us. We have Sameet Chavan, Chief Technical Analyst and Derivatives at Angel Broking, joining us. Sameet, good morning. We have seen substantial weakness on the indices now. Are we expecting a little bit of a break, or can we expect this weakness to continue based on whatever you're witnessing on the charts? Sameet, can you hear me?
Yeah, I can.
Sameet, good morning. Yes, I actually wanted to know about whether or not we can expect more weakness when it comes to some of these indices, or can we expect some consolidation?
See, consolidation or minus intraday bounce back is quite possible, but we believe that we are more or less in the sell on rise kind of market. Since last couple of days, 10,500 has been acting as a very strong support, and we saw 2 days breather around it. But yesterday, in the second half, Nifty decisively broke that important support level, and then we saw massive selling pressure in the latter half. So that clearly indicates that overall, if you see, we are likely to see some kind of selling pressure, and there's further pain left in the market. So in our sense now, in case of a bounce back also, now 10,500, 10,600 would act as very strong resistance. So any bounce back probably toward those levels would be an exit opportunity. And going ahead, we would expect continuation of this corrective move at least toward 10,350 and 10,300.
In that case, Sameet, are you betting on stocks on the downtrend or the uptrend, and which stocks will they be?
See, for the day, I have two recommendations. First one would be on the sell side, Bharat Financial. This has been one of the outperforming stocks since last many months. But the way, it has been trading since last 3 weeks, if you see the daily chart, it has been trading within a rising wage pattern. And yesterday there was a decisive breakdown from this crucial price pattern. So we believe that this stock is clearly poised for a decent corrective move. For next few days, we expect the stock to slide towards 1098, so one can go short with a stop loss of 11. And the other call is a slightly contra call, Bharti Airtel. We believe that around 350, 355, the stock has a strong support. There's a falling trend line which converges around 355, 360. And since last 3-4 days, we have been seeing some kind of buying interest at low levels. So we would expect a relief rally in Bharti Airtel. 372 is the level to watch out for, so one can go long with a small stop loss of 353.
Okay, I think we can also bring in Dharmesh Shah, the Assistant Vice President for Technical Research at ICICI Securities. Dharmesh, good morning and thanks for joining us. We are seeing a lot of weakness on the benchmark indices. Would you say that there is more weakness in store as well when it comes to the major indices?
Yeah, good morning. Yeah, definitely. I think so. If you look at the last 3 to 4 trading sessions, I think so there has been clearly a witness in the most of the frontline indices as well as on the mid cap side. We believe, I think so, going forward, I think so Nifty remains to a strong support in the range of 10,300, 350, being a 200-day EMA which is placed at around 10,330, and also the 61% retracement of the move from 9950 to 10,950 also placed at around 10,330. So going forward, we believe, I think so this consolidation should pan out in the range of 10,300 to 10,600. Now coming to the point of whether we are going for a severe breakdown or more for consolidation. So we believe, I think so, market can go for more of a higher base formation from going forward from the current levels, where 10,300 to 350 will remain as a strong support or a more of a basing formation for the market, where we will see a more of a consolidation and a stock specific action going forward. So overall, going aggressive shorts at this point of time is not recommended. But yeah, definitely at the lower levels in the range of 10,300, 330, one should go for long positions in Nifty too. So overall bias remains to be more for trading range or the range of 10,300 to 10,600. But any dip towards 10,300 to 50 in a panic should be looked as a buying opportunity going forward.
What about specific stocks, Dharmesh? What is it that you would be recommending to the viewers or to your clients today?
See, from the intraday perspective for the day, we believe, I think so, IT should do good going forward, and we believe Tata Elxsi is the one stock where yesterday the clearly outperformance was clearly seen on the intraday basis. So and with the volume supporting in the range of 1190 to 1210, we believe, I think so, the stock should finally give a breakout on the consolidation pattern, where target remains for the intraday remains to be in the range of 1223 to 1225, keeping a stop loss of 1194. Coming to positional side, where we believe, I think so, if one has a horizon of a 6-month horizon, when we believe, I think so, AI engineering, the one space on the capital goods space, where we believe our stock has seen registered a breakout of the 3 months of consolidation, and this consolidation was been supported with strong volumes and good results too. So we believe, I think so, the stock is heading much higher from the current levels, where it could be head towards 1895 is more likely a target for AI engineering, keeping a stop loss of 1390. Now 1390 remains to be the rising trend line support, and also the 80% of the move of the last leg of the rally comes to around 1385.90. So 1390, keeping a stop loss of 1390 and a target of 1895 from the horizon of 6 months. We believe, I think so, the stock has much potential from the current levels too. Now coming to second stock, where we like MNC Pharma too going forward, and we see in this last 3 to 6 months the outperformance was clearly seen in MNC Pharma compared to the most of the frontlines pharma space. So we believe, I think so, MNC Pharma should do good going forward too, where Pfizer again the long consolidation breakout, I would say a flag breakout in the range of 2390 to 1895, high. It was a trading range for Pfizer, finally has given a breakout. So we believe, I think so Pfizer should be looking much higher target from the current levels. A flag breakout pattern implication target comes to around 29.50. So overall, I think so we believe, I think so Pfizer again on the MNC pharma space will remain to be outperformers going forward. So these are the top two picks for the 6 months horizon if one has a view from the market going forward too.
Okay. So those are some technical views on some stocks. Yesterday the fall in the metal names was fairly exaggerated. 5-6% was the order of the day for Tata Steel, JSPL, SAIL. All of the metal names came off without exception. At least the steel companies did come off. Parthiv, what's happening here? There was ferocious price and volume activity in at least the steel companies in trade yesterday.
Yes, absolutely, Neeraj. I think it was a little surprising to see a lot of steel companies and especially metal names. Out of the metal names, even if we were to talk about a stock like Vedanta, one can attribute that to some sort of news-based activity. But I think the steel companies, the way they corrected, I think that was quite massive. Irrespective of the fact that we didn't see any such international price movements in terms of the metal prices. And in fact, currently the spreads for all these value-added players, names like Tata Steel, JSW Steel, JSPL, I think is quite healthy. And in fact, I believe that this could be used as a very good opportunity for players to bet on this particular sector, where I still feel there is a bullish stance for the next 1.5-2 years. At least there is a visibility on that front. And I think a name that I would stand out would be JSPL. I think this stock delivered very good set of numbers in Q4. This is despite their power assets languishing. Only the steel assets, I think they are really doing a fantastic job at 12,000 rupees EBITDA per ton. And the management giving a guidance of delivering similar numbers for FY19 with 9 million tons of capacity. I think the steel unit cash flows would be more than enough to help them reduce the debt by 3,000, 4,000 crores. And if at all in between that, if the power assets were to get the required coal supplies, I think that could also add to the cash flow. So I think we are quite upbeat on Jindal Steel and Power. This is one company which post correction I feel that we can add on to the portfolio.
Parthiv, the earnings for SBI weren't necessarily great. The argument, of course, is that the earnings were better than expectations. How are you evaluating this bank right at this point in time?
I think especially in case of SBI, I think this stock had really massively derated going into the numbers. And then when the numbers came and post the management commentary, it was kind of on unexpected lines in terms of, yes, this is one quarter where we have shown very elevated provisions. They talked about a new watch list, especially for FY19, and they were expecting only 60-70% of those loans from the watch list to kind of go into slippages, which was a number which was a lot lower than what the street had envisaged. So I think that were the key reasons why we saw that despite very overall tepid market performance, I think SBI did extremely well in terms of kind of bouncing back from its lows. But I think frankly, this will never ever be a stock on our radar in terms of being an investment portfolio stock. If you see the 10-year track record of this company, I think it has been horrible. In fact, savings bank account of SBI would have delivered better CAGR returns as compared to one would have parked 10 years ago in SBI. So I think these public sector banks are at the best good positional trades if one is very good at entering at the right levels and exiting at the right levels. Any day I would prefer the private sector banks. I think names like Kotak Bank, HDFC Bank in the large cap front, and in the mid cap front, I think names like RBL Bank and even Federal Bank post correction, I think looks a lot better over the next 2 to 3 years, which can create more value as compared to an SBI.
Okay. But Sameet, Tata Motors is likely to open in the red. And I know you're unlikely to give us some quotes before we start seeing the opening at least. But at this point in time, what levels can we expect when it comes to Tata Motors?
See, I mean, clearly since last many months, this stock has been, correcting from higher levels. If you look at the broader degree chart structure, it has been maintaining its low top, low bottom formation. Any bounce back is clearly getting sold into. But we believe that now downside for this particular counter would be limited. Wherein on the low side, 290, 292, there's a cluster of supports. So we believe that in case if the stock, comes around this important support zone, we might see some kind of buying enters around those levels. So after reaching 290, 292, there's a possibility of some kind of relief rally in this counter.
Interesting. aside of all the metal names, etc., that we discussed the last few days, the auto pack has come under problem. I know Agam was talking about Tata Motors, but it's not just Tamo. I was looking at the YTD performance for Maruti, despite solid numbers, down about 15-16%. Ashok Leyland has come off a little bit as well. Motherson Sumi, the numbers were slightly tepid. Minda Industries was probably a separate case in point, but otherwise all of the other auto component names have come under pressure. Parthiv, less than a minute to go. A very quick answer. I mean, are you looking at buying into any of the auto/large auto component names?
I think amongst the auto components name, Sarda Technology is one stock that we like. It's going to report results soon, and I believe that this company can be a good investment bet. It has a lot of focus in the domestic market, where all the verticals, the two-wheeler space, the CV segment and the construction equipment, all are doing well. They had a capex of 500 crores. The asset turns will be seen going ahead. So I think Sarda Technology is one company in the auto ancillary space which we are really liking and would like to call on an investment for the next 2 to 3 years.
Sarda, yeah, okay. So watch out for that stock as well. But 44 seconds to go, and while the SGX is pointing towards a tick of green, the pressure is undoubtedly there.
Absolutely, and that's evident in the Asian markets. We are looking at some weakness, some cuts coming through. So when it comes to something like the Nikkei, or for that matter, the Shanghai, well, Shanghai, as a matter of fact, has recovered from its lows and it's now trading in the green. So, well, that's turning out to be a positive. Of course, Hang Seng is where it was when we checked it last. And what does it mean for the SGX Nifty? Well, a positive uptick, as Neeraj has suggested. Currently at around 10,460. The question is, should we see about a short covering? Can we move back about the mark of 10,500 on the Nifty? Let's wait and watch. For now, well, muted cues open when it comes to the Nifty as well as the Sensex in pre-open, waiting for these rates to show some stability, but it seems that the Nifty right now is marginally in the red. Sensex, on the other hand, marginally in the green. Again, we're going to have to wait for these rates to stabilize. That said, let's pull up Tata Motors. We've had a drop of 50% in its bottom line, and as expected, showing a downtick of 5%. Can these losses be deeper? We'll have to wait and watch for, well, the opening coming through. GAIL is the earnings that we are expecting today. Well, largely stable earnings expected, down as much as 1.3%. In terms of ONCs, which have seen substantial weakness over the last couple of weeks, that's HPCL for you. Can we expect some arresting of the weakness that we saw over the past couple of days? Well, it seems that Indian Oil Corp is looking at an uptick of around 1.3% marginal losses for HPCL and BPCL. And let's also take a look at Vedanta as well as Tata Steel. Let's start off with Vedanta. That's marginally in the red for now. And can we take a look at Tata Steel? Tata Steel showing an uptick over as much as 1%. Finally, SBI was one of the big gainers in yesterday's day of trade, one of those few stocks which kept the market so well in check, and that's looking at another uptick of around 0.5%. These are some of the large caps that I'm tracking right now, Neeraj.
Well, I see what Jet Airways is up to, Agam, and should have started off lower. Wow, slam dunk there. May not be 10%, let's wait and watch, maybe 10% too. The auditor's comments too, very, very disconcerting. This one arguably could start off as one of the worst performers, but let's wait and watch. Let me reserve my thoughts until the first 8 minutes are out of the way. But looks like starting off on a negative footing. Jet Airways is one. Let's see what the rates are showing. I'm just trying to get the rates up on my screen. Ingersoll Rand, must be some corporate activity, 24% down. Just let's wait for that. Must be some dividend or something like that which has come into Ingersoll Rand. Let's wait for that. Astral Poly's had a big cut today, about 5.5% down. Balrampur Chini continues its slide. So after some good days over the last few days, last 3 sessions, 3 strong sessions, then a pullback yesterday, and the pullback looks like continuing in the session today. And lo and behold, watch out for Symphony too. It was just a brief tick of 3% down. I don't know if that changes. Yeah, it does change. So all over the place. Let's give these rates a chance to settle. I think Jet Airways is probably a clear-cut loser. We might have, well, some gains for GVK. There was a surprise profit there. Let's wait and watch. 9% higher right now. Let's wait and watch for GVK. And IGL post the numbers, 3.5% higher. Looks like doing okay. Bring up the currency on the board for you as well. And Let's see how that's starting off, 68.33. So this is arguably some bit of pullback, but in yesterday's session, the lowest level since November 2016. So before we get in Shraddha Babla with the brokerage notes for the morning, let's get in a currency voice out here to talk about what could be the near-term impact on the rupee, if it is possible to assess that in the first place. I think Bhaskar Panda, if I'm not wrong, should be joining us. Yes, he's Senior Regional Head of Treasury Advisory Group at HDFC Bank, joins us on the phone line. Bhaskar, good morning. Thank you so much for taking the time out. I think by and large the reasons would be well known, but none of them show any signs of letting off from those 16-18-month lows. Do you envisage more pressure on the Indian rupee?
See, if you look at the reference pointing, probably the only reference point I have is 68.86, which we had seen, at the height of rupee depreciation. If you look at the trend, yes, rupee depreciation trend is there. If you look at the graphs, that shows clearly that it's going one way. If you ask me whether it is going to go one way, I will say no. Probably it will be calibrated, but there is a lot of uncertainty in the minds of both exporters and importers at this point of time. Probably that is playing in the market in the dollar rupee rate itself. Secondly, if you look at, there has been an outflow, as you said. Most of the regions are already known. There has been outflows on debt. There has been outflows on equity. Both we have got oil at 80 plus. We have got so many things going, political things going on, so many things. So all these are net. The effect of dollar rupee is the net of all these things. The one thing that we have to again, reconsider is that. Whether the dollar index is going to go up from here. If it goes up, which is the case probably, then you will see some more depreciation coming.
Bhaskar, good morning. In that case, are you keeping in mind any time spans or timelines when it comes to the rupee likely hitting 69 anytime soon?
It can happen, this week, it can happen next week. There has been a lot of, action for calibrating the move. But it's anybody's guess. It can happen even, tomorrow, as soon as tomorrow. We don't know.
Well, I think that sums it up. Bhaskar Panda, as veteran as it can get, forget the levels, but the broad trend seems to be one way. Thank you so much, Mr. Panda, for joining in this early in the morning and giving us that quick view on what the currency is doing and what you believe it could do as well. Doesn't seem to be near-term pullbacks unless something happens on the global front and the dollar weakens against some of the other emerging market currencies. For now, though, it seems to be a show of strength for the dollar vis-a-vis some of the other EMs. 68.32, bit of a strengthening today from yesterday's lows, but nowhere out of the woods as yet. Okay, before we move back to our Shraddha Babla is joining us with the top brokerage calls for the morning. Good morning, Shraddha.
Good morning, Neeraj. So we have Credit Suisse, which has initiated coverage on some of the financial services companies. One being JM Financial. They've initiated it with a neutral rating and a target of 150, which is a 13 to 14% sort of upside potential from current levels. They've said that it has diversified from the capital market business player to over 75% of its profits now coming from their fund-based businesses. They're growing their corporate loan book along with a foray into home loans as well. Their lending businesses generate a superior ROA and lower credit costs as compared to peers. The asset reconstruction company has a better track record of resolutions versus peers, and again some of their subsidiary companies have marquee investors in them, so that's driving their view on JM Financial. Credit Suisse also has initiated Aditya Birla Capital with an outperform rating and a target price of 175 or larger, 24-25% sort of an upside that they see here. They've said that it's a financial conglomerate with their established businesses as leaders in their own segments. And additionally, the recent businesses are also amongst the top emerging players in the wholesale and retail lending as well as insurance businesses. Life insurance business is showing profitability, which they believe is a positive sign. And they say that any upgrade in credit rating would be a key catalyst for the lending businesses. So that's again driving their bullish views or initiation on both these companies.
Shada, thanks for joining us and giving us those cues on broking houses. Dharmesh, if I can take up Infosys with you, we have been seeing a lot of strength recently. Are we expecting this trend to continue? Would you recommend fresh longs at this point in time in Infosys?
Yeah, definitely. If you look at the overall IT space, I think so there has been the outperformance clearly seen in this last leg of fall. So we believe, I think so, Infosys yesterday also showing the strength in the falling market. We believe, I think so, the more for consolidation in the range of 1180 to 1210 has finally been given with a breakout, where we believe, I think so, 1230, 1240 more likely target for Infosys, keeping a stop loss of 1175. So we remain with the positive in Infosys, and any dip towards 1190 should be looked as a buying opportunity in Infosys.
Okay, well, HCL Tech 2 looking like starting off on a good note. So as the 8 minutes are coming to a close, or in fact have shut shop, I think IT seems to be starting off on a good leg. Bajaj Finance seems to be stalling its fall yesterday, but Tata Motors back to those 300 odd levels. Looks like starting off at 300. Sameet, a quick view here. 2 days of a bounce. The results resulting in the stock being sold into yet again at 300. Now that we know what the stock is likely to do this morning, what would a trade be, if at all?
See, as I've just said that, in case if the stock reaches its strong resistance of 290 to 290, we might see some kind of buying interest at low levels, because 290, 292, if you see on the weekly as well as monthly chart, all these are multi-year support levels. So we might see some kind of bounce back from those important levels. So in my sense, if it trades around 300, 302, it becomes a no trade zone. So first you have to wait for a breakout to happen beyond 318, 315. Before that, if it reaches 290, 292, one can take a punt, one can go long, keep a stop loss somewhere around 284, and we would expect a decent bounce back.
Okay. Keep in mind as we look at the losers. So I just wanted to ask about Tata Motors, because the stock now visibly starts lower. By the way, DVR2 about a couple of percentage points lower. Ingersoll Rand, I would suspect, has gone ex-dividend. There's a special dividend of 202 rupees per share. I would suspect that would be the case, which is why at least the data would have elapsed, which is why this cut in Ingersoll Rand. Jet Airways is the principal loser, starting off about 6% lower. Let's tell you, since we are minutes away from the market open, let's tell you all that you need to know to stay ahead in trade today. Tata Motors reports disappointing margins for both the India and business and JLR. Brokerages cut target. The stock likely to start off 3% lower.
The street will keep an eye out for GAIL, Cummins India, Granules, Pidilite Industries, United Breweries and United Spirits as these companies report March quarter earnings today.
A strong quarter for Apollo Pipes, Repco Home Finance, Suntech Real Estate, KPIT, PNC Infra and Natco Pharma.
While Jet Airways, Shipping Corporation of India, Premier Explosives, GET&D and Shalimar Paints disappoint.
Fabra Investment Funds buys 1.2% stake in Kaveri Seeds. The stock starts off 3% higher.
And in brokerage calls, Credit Suisse initiates coverage on GM Financial with a price target of 150 rupees per share, and AB Capital with a price target of 175 rupees per share.
Well, AB Capital is in need of some oxygen for sure. It's trading at 52-week lows yesterday. Parthiv, do you like this one? Ever since listing, it's done only one thing, and that's disappoint investors. There has been eternal hope, somehow no result. At 140, it was trading at 52-week lows yesterday or day before. Would you buy into AB Capital, or are there better financial intermediary services opportunities available?
Absolutely, Neeraj. Very rightly said. I think a lot of hopes were shattered ever since this company got demerged and listed initially at almost 240, 250 levels, from which it has come down to almost 140, 145 levels. And one hope was that at around 147, that was this Azim Premji's stake, almost 3% stake, which they had bought even before this delisting story, the demerger story. But I think, Neeraj, frankly speaking, this is a company which now at this current juncture, current levels, current valuations, does have a lot of inherent value. the insurance business is tending to perform well. And one concern that probably the market would have is on the NBFC book. I think if at all this company, which is a very good possibility, were to kind of manage their borrowing in a AAA rated scenario, a sort of ratings upgrade, that would really help them a lot in terms with their spreads. But even the ARC business and all the other upcoming business will take time. They're doing very good in the AMC business, which is a very healthy, profitable business. In fact, the numbers have also been coming in very good. And despite that, we have seen continuous selling pressure in the stock. So from here, I really feel that if one wants to bet on the Indian financial services growth story, I think from here over the next 3 years, I think AB Capital should not really disappoint the way it has in the past. And from here, I feel the downside should be very limited. But any sort of triggers that I just mentioned, I think would massively re-rate the stock. So I think I would definitely suggest a buy here at the current levels of around 145.
Okay, well, we just have about a minute and a half left for open. So let's go across to our technical experts and see what calls that they have for today. Dharmesh, I'll come to you. What stock are you betting on? What's your top pick today?
Yeah, top pick remains to be the IT space, and where we believe, I think so, Tata Elxsi should do good at the current levels. I think so at around 1200, 1205 was the closing. So we believe any dip towards 1200 to 1195 should be looked as a intraday opportunity for going long with a target of 1225 to 1227. So Tata Elxsi remains to be a top pick for the day.
Sameet, just 40 seconds left. What about your top pick?
Bharat Financial, after a long consolidation outperformance, the stock is poised for some kind of profit booking. Yesterday it gave a breakdown from a rising wedge pattern, so we believe that the stock is heading towards 1100. So one can go short with a stop loss of 1151. Target would be around 1098.
Okay, gentlemen, stay on. We'll take in some opening thoughts from you before, or rather opening thoughts, yeah, once the markets start. But 12 seconds to go for the markets to kickstart trade. We are likely to start off about 1/3% higher on the benchmark indices. The Nifty Bank, though, not looking like starting off on a really strong footing, maybe a flattish start. Yeah, so flat for the Nifty Bank. The mid caps, the large caps, the Nifty and the Sensex start off about 1/3% higher. Let's see if this is a failed start, failed attempt at a pullback, and whether we continue on the path that we seem to be embarking upon yesterday. We were down 1% in trade yesterday. The mid caps and the small caps were doing much better in trade yesterday, and in today's session to start off about 1/3% higher. So not a bad start. Maybe more green on the screen. Let's see if it lasts or no, but get the heat map up on the screen. Yeah, fair bit of green on the screen. Save for Tata Motors, we don't have too many losers. Yes, the OMCs continue to slide a little bit, but let's wait and watch whether that gets arrested or no. Tata Motors is the weak spot, but just about 1.5% lower. On the gaining side, not too many news makers. I think some bounce back by the metal names like Tata Steel, for example, is up about 1%, and IT seems to be doing okay. I don't know if it's the currency playing part here from a trading sentiment perspective or no, but IT seems to be doing reasonably okay. Fair bit of green, that's not a bad start. Let's take a look at the mid non-Nifty end of the market to try and figure out what are the moving stocks, because on the index we don't have too many really. So margin expansion and a healthy margin expansion seen for both of these names. Firstly, Ross 7.5% up, but what a superb quarter. And Natco Pharma too, in a quarter which is starved for really good numbers from the pharma companies. This one has delivered and up about 4% in trade. What about some of the others? Well, good results for Rupa, that's up about 4%. Suntech about 1.5%, so that's not doing all that badly. And PNC Infra too, by the way, I think showed some very good operational metrics, and which is why the stock might be reacting the way it is. So these are the good results that we've seen today, and crash landing, so to say, for Q4 numbers for Jet Airways, and that one is down about 5%, not without reason, I would presume. Last but not the least, the key bulk deals that we spoke about, Indian Terrain picked up by Malabar Investments, and Kaveri, which has been picked up by Monish Pabrai. Both of the stocks start off on a positive footing. Agam, what are you spotting?
Seeing surprising moves for a state corporation of India, pardon me, Shipping Corporation of India. That's seen an uptick of around 3%. This is after weak earnings coming through. Currently at around 63.5. I'm also looking at gains in something like, Reliance Communication. That's also up and about. And we have spoken about Bombay Rayon, which continues to advance forward. That's up as much as 4%. Of course, on the losing end, we continue to see weakness in something like a GET&D. That's of course on the back of earnings. And e-clerks also declines by as much as 4%. We have more weakness in Adani Transmission as well, down 2%, and Godrej Industries also bedding down on the Nifty 500 index. That's also down 2%. On the whole, however, well, it's mixed cues, and it seems like the advanced decline ratio, if not evenly poised, maybe towards the gainers for now.
Okay, let's get in quick opening thoughts from our experts before we thank them. Sameet, Chavan, anything that stands out for you? 3 minutes into trade, the market starting off the way they are, anything that looks interesting?
I think let the market stabilize a bit. First half an hour would be quite crucial. If it manages to sustain beyond 10,450 mark, then we could see some kind of bounce back. But we believe that overall, we are in a sell on the rise kind of market, and on the higher side, 10,500 followed by 10,600 would act as a very strong resistance. So at this juncture, I won't take any fresh trade. I would rather wait for first half an hour and then one can take a call.
Dharmesh, what about you? Index or anything specific in the stock side that is standing out for you on open?
Yeah, I think so. I think so. Nifty seems to be oversold in yesterday, as the oscillator is indicating a reading of 6. So we believe any dip towards in intraday in Nifty towards 10,400 to 10,395 should be looked as a long opportunity in creating a long position in the market for target of 10,450 and keeping a stop loss of 10,375. So dip towards 10,395, 400 should be looked as a long in today's trade.
Dharmesh, Sameet, thanks for joining us and giving us your views. Of course, we will continue to track some of these technical levels that our experts have suggested. But Parthiv, before we let you go, we really haven't taken your view on the markets in general. What factors do you think will move these markets now that we are moving towards the end of the earnings season?
See, frankly, I think we've seen a lot of deterioration in terms of the macros. We are continuously discussing that, it's not something which is game changing in terms of being very depressing for our markets. But yes, I think the premium valuations that our markets have been commanding in the emerging markets basket will tend to kind of come off, especially at a point in time when the earnings are not really firing on all cylinders. It's not like a 20% sort of a earnings growth scenario that we have right now. So I think some sort of correction, especially a cool off in the small and mid cap valuations, is something that we are still envisaging over the course of time. With I think the borrowing cost maybe going to inch up going ahead in time. That's not something which bodes extremely well with these small mid-cap balance sheets. Many pockets are very frothy in terms of the valuations they're commanding into. So our strategy is very clear, I think, irrespective of the noise that we are hearing globally in terms of the macros or the oil price, which is temporarily boiling. I'm using the word temporary because in the long run, oil is in an oversupply zone. But I think this can be used as a good opportunity to look into stocks which have corrected, stocks and especially some sectors which have good growth visibility over the next 2 to 3 years, where the earnings can compound by 20-25%. So there are such pockets in the market, and these are the ones where I feel that the downside would be limited, and over the next 2 years these will really handsomely reward the investors. So one will have to be very selective when one builds a portfolio in such a market scenario where we're going to come into a lot of political turmoil also going ahead over the next 2 years.
Interesting. Okay, Parthiv, we'll leave it at that. Many thanks for joining in today and giving us your perspectives. The market's about a third of 1%. Let's welcome a very special guest. Pradip Shah, Chairman at IndAsia Fund Advisors, joins us on the show. He now has added responsibilities as well. And Mr. Shah, good morning and congratulations. Haven't had a chance to you since you got an additional role on the government side as well. Congratulations on that. I just want to start off with your thoughts, though, before we talk about banks by and large, on whether you believe we are at a precarious situation on an equity markets perspective, considering not just what's happening to the local macro, but also on the global front as well.
Yes, I think we talked on your channel a little while ago that with oil prices rising and then the current account deficit increasing and the dollar appreciating versus the rupee, plus US interest rates rising, and then the US-China trade problems as well as trade dialogues or threats, and the sanctions against Iran and so on, all that does cause some concern for me. I think The Indian markets were headed down at that time. Were doing well, but I expected them to head down as we discussed at that time. Even though the economy is doing well in terms of demand because of 2 years pent-up demand with the demonetization and the GST issues, the good monsoons, relatively good monsoon last year and the better monsoon the earlier year, all that pent-up demand is now reflected in almost all companies' product sales. But where we still have this fear is this the US interest rates going up and the current account trade deficit, and most importantly, in our own country, we have looming elections. And we saw in the Karnataka elections, while the BJP did better than the last time, there is fear that it might not get the same kind of mandate that it got in 2014 next year. In which case, will it be able to make as effective structural changes and tactical changes as it would like? So that concern, I think, is going to accelerate going forward. And therefore, what you say, markets have to be viewed with concern going forward. They will not necessarily be going up. It will be individual stock specific movements upwards. Otherwise, the tendency would have to be going down, drifting down.
Mr. Shah, do you believe the markets will price in the impact of all of these well before the event does happen? The market tends to look forward, assuming that there is a realistic chance of the mandate not being completely in favor of the BJP in May 2019, or for that matter, there being more rate hikes and more weakness for the emerging market bonds and currencies as opposed to what we're seeing right now. Do you think it will be bunched up and factored in over the next 3 or 4 months? Is there a realistic chance that we skating on thin ice and might just crack very, very soon?
I think the drift downwards has already started in anticipation of these political uncertainties coming to reality, and also because of this oil price being so high, which hurts India very badly. So I think, and you see the currency also has dropped, so the foreigners are pulling out. Now, I think here's one opportunity for the government to tweak some things to bring back that interest in India from foreigners, whether in equities or debt instruments. And one of these is the dividend distribution tax for equities. If they were to tweak it so that institutions overseas can get credit for the tax paid here in their income returns overseas, it would make a huge difference to them in terms of net returns, and it doesn't cost India anything in terms of revenue loss. So I think government will have to be a little more proactive. And of course, for our domestic scene, we must continue on this growth path and accelerate it. So government must, which is doing extremely well, spending on infrastructure projects and timing the infrastructure projects evenly, timing the infrastructure spend evenly throughout the year. But in addition, it must continue the focus, which it has reduced just now, on ease of doing business and ease of living. I think that is where the bureaucracy is seen to be the enemy of the people and enemy of the government, and I think that must be corrected. The government must shake up the bureaucracy to be in sync with the government's thinking and Prime Minister's thinking of ease of doing business, creating investment, creating job opportunities. Today there's so much, unfortunately, friction because of the bureaucracy.
Mr. Shah, good morning. What is the likelihood that we can see a change in the RBI trajectory, the rate trajectory this year, and what kind of implications can that have on Indian equity markets?
I cannot predict what the RBI will do, but I would like to suggest that RBI will relook at what is apparently its policy objective in its monetary policy. Everyone knows that it is very conscious of price stability, which is wonderful. But in addition, as in the UK, as in the United States, the central bank is required by law to also look at full employment as one of the objectives of monetary policy. And in the UK, of course, price stability is the principal objective of monetary policy. But in addition, the Bank of England it takes the view that it should support government's policies on economic growth and employment. So I think if that were to be expressly visible in RBI policy, it would bring a lot more confidence in the minds of people, and RBI would not be the butt of everyone's comments that it's not reducing interest rates or whatever. I mean, it is very conscious of inflation, which is very good, and I think that is one of the great things about our RBI.
Right, Mr. Shah, then shifting focus to equity markets, well, what have you made of earnings, and can we expect that elusive double-digit growth in the markets in FY19?
You know, the earnings will do well. I think will continue to do well because there's a momentum in the economy. The demand is very good, whether it's in consumer consumables or in consumer durables or in even industrial products and capital goods now. So that will happen, but unfortunately, I cannot see justification for the markets increasing as a whole. Individual stock-specific improvements, certainly, as you pointed out earlier, with the results that, for instance, NATCO has shown, it's jumped up 4% and so on. So those kinds of things will happen. But overall, the market has to take into cognizance the uncertainties of the elections and the uncertainty of the government getting the same kind of mandate, the present government getting the same kind of mandate as it has had so far, as also the uncertainties on account of the currency, with money flowing out, with current account deficit being so high, the oil going so high. I don't see what is the logic for the market to go up from here for us in the future.
Yeah, no, I think the question nowadays, Mr. Shah, is not about whether the markets will go up or no, but if they stay put, then at least the mid caps and the small caps, which are delivering good numbers, could do well. But I understand your point completely. I have a tricky question for you, Mr. Shah. I don't know if you're in a position to answer that, considering they are now on the Banks Board Bureau. But the shunned out public sector banking space, do you believe as an investor, is there a chance for revival? And I don't know if you can answer this question, so take my question with a pinch of salt.
You know, I'm not speaking as a member of the Banks Board Bureau just now. I am a member, but that's not the subject matter of our discussion. So I think the public sector banks have still to undergo a lot of pain. I know the chairman of State Bank of India has said that the worst is behind it, but that's maybe for State Bank of India. I fear that there is a lot more pain left to be visible in the bank balance sheets and profit loss accounts. And one of the things, regrettably, is that when government decided to give capital to the banks, it was as if independent of the banks' kind of losses. If you remember in 2008, when Citicorp was bailed out by the United States, Fed and Deposit Insurance Corporation and the Treasury, what they did was they identified the pool of toxic loans and said that 10% of the losses on those toxic loans would have to be borne by Citibank, and the rest, 90%, would be absorbed by these institutions. Now, unfortunately, we have not had that kind of linkage. So what I'm seeing is that the creditors' committees of these banks and so on are relaxed about how much losses they have to take. I mean, they try their best to maximize it, but they're not making any extra effort to maximize their returns from these toxic loans. And that is a big negative, I think, for the public sector banks. That, the creditors committee feels that, oh, it was not in my time, or it's not my responsibility, I have to just solve this problem out. They must take a proactive stand and say we must maximize returns from our bad loans, so that they preserve capital and don't have to keep drawing on government. And government is giving its capital kind of very easily.
Okay, I have one final question, Mr. Shah, and that is on the oil dependence, if you will. The OMCs are in eye of a storm, and there are 2 or 3 measures that the government can take. Which of these would be the most prudent one, considering that if they ask the upstream to bear a part of the subsidy, it may be great for the downstream companies, but then the upstream companies come under a cloud as well, and the government is trying to ensure, I'm guessing would be trying to ensure that one doesn't benefit at the cost of other. What do you think is a possibility available in front of the government?
I think you're absolutely right. It would be completely unfair of government to put a portion of the subsidy burden on its public sector units, almost all of which have private participation from the public. So I think it would be completely unfair. If government wants to take a hit itself, it can reduce excise duties. Now that itself may help in the consumer perception as well as in votes, but it will be at a cost of revenues for them. So maybe they will have to make up revenues in other ways by way of divestment or by cutting back on expenditure which is infructuous or which is of revenue nature, so that they continue with the capital expenditure but don't have a fiscal issue coming up. I think if anything has to be done, it should be on the excise front, and they should bring down a little bit of excise to alleviate the problems for the consumers. At the same time, on a long-term basis, they must go ahead with public transportation, not encourage this private transportation. Public transportation is so much more economical.
Well, yeah, let's hope that some of the infra projects that are being funded via these excise rates, Steve, fructifying anytime soon. Mr. Shah, so good having you. Thank you so much for your macro thoughts as well as for some of the thoughts on specific pockets as well. Much appreciate your time. Well, that's Mr. Pradip Shah, Chairman of IndAsia Fund Advisors. The markets, about 1/3% for the Sensex, 1/4% for the Nifty. The Nifty bank slightly lower than that, but by and large a start in the green. Mid caps and small caps are doing reasonably okay. Speaking of mid caps and small caps, we talk about a couple of these pockets on the other side of this break. We decode the Q4 earnings of TD Power Systems with Nikhil Kumar and talk about the aviation space a bit later on as well.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
They still don't know you after all these years?
क्या करें? पहचान ही नहीं है.
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE Merge. It's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Merge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
White shirts, कितने plain और simple. Fog scent, plain और simple white shirt को बना दे special और fashionable. Fog scent, new fashion wear for men.
Hi guys, we're completing 1 year of the mutual fund show on Bloomberg Quint. Take a look at all that we've done over the last 12 months.
Optically, nothing is cheap. Volatility is integral part of financial markets.
Prices change every microsecond and NAVs change every day.
I have been always suggesting that if you can be Kumbh Karna, invest today and go to sleep for next 14 years.
Join us on the next leg of our journey as we attempt to make the conversations even more meaningful on your favorite show, The Mutual Fund Show.
The Mutual Fund Show Anniversary Special, Wednesday 4 p.m. only on Bloomberg Quint.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. Let's get into an earnings conversation. TD Power Systems saw a healthy rise in its top line last quarter, but that was spoiled. But what spoiled the picture rather was a sharp uptick in tax expenses, which rose by close to 300% over the same period last year. So was it a one-off, or will the industrial AC manufacturer have to foot similar tax bills in the future? And that's not all really. How is business sentiment looking like? Let's pose all of those questions to Nikhil Kumar, the MD of the company. He joins us right now on the show. Nikhil, good having you. Thanks so much for joining in. Let me first get that tax question out of the way before we get into the pure business. What happened in Q4, and is this a sign of how the tax expenses would look like going ahead for you as a company?
No, I mean, the tax is not really. I don't understand your question on the tax, because there's no real dramatic increase in the taxes. What I think has really affected our numbers last year has been a dramatic, a 400 basis points increase in our costs, raw material costs, because one is that the prices of raw materials like copper and steel have gone up dramatically last year. And the second is that, we've also been affected by the exchange rates, especially for the first 8 months of last year, because we export a lot in euros. The euro average realization on the euro also has been much lower than anticipated. So that has affected our overall gross contribution by about 400 basis points. And that works out to something like 16 to 18 crores. And that's affected our margins, even though we've had a healthy growth in the top line. We've really found it tough to maintain a decent bottom line.
Please correct me if I'm wrong, but while I get on board the business questions, and we'll talk about that, but hasn't the tax expense for the quarter gone up substantially? I think the number out there from 0.93 crores to 3.55 crores, or are my numbers wrong?
Yeah, actually, the tax for the quarter has gone up because we have made profit for the quarter.
Right.
But for the overall year, it doesn't really, for the overall year, we're not paying tax because we still, overall for the year, we have a 17 crore profit. So we're paying tax on 17 crore. But the tax is in line with our historical, we are a full tax-paying company, so we pay 35% tax.
Yeah,
so
okay. So you're saying the rates haven't changed. Okay, fair call. You've been guiding.
No. For us, we are a full tax-paying company. We pay 35% tax.
Yeah.
Our PBT on a standalone basis, our PBT was 17 crore, and PAT is about 12.5.
Yeah. Fair call. Okay, let's talk about some of the business questions. Now, you've been guiding for about 7 to 8% EBITDA, if I'm not wrong, for some time now, at a consolidated level, either on a consistent basis or for a year as a whole. When do you envisage those numbers to be met?
This last year was the last year where there's an impact of negative numbers coming in from our subsidiary, where we did the EPC business for power plants. Now that company has been completely shut down, and last year is really the last year when any negativity will spill into the standalone basis. The standalone numbers have been fairly healthy. So as I said, there's a 17 crore profit. So not as good as we expected it to be. We have lost about 400 basis points, like I told you a little earlier, based on dramatic changes in raw material input costs as well as exchange rates. But in the current scenario, I think one of the two factors, the exchange rate at least, is definitely in our favor, hugely in our favor right now. And we have to battle against raw material price increases by cost reduction. So that's the real challenge ahead of us for this upcoming year. In terms of, I guess the next question is really going to be about the business expectations.
I could take that. I was actually wanting to ask you about the subsidiaries and how, while you've closed a lot of these subsidiaries as well, there continues to be an additional loss from the subsidiaries as well. What would that do? And then we can, of course, get to the question that you spoke about.
Well, we have overseas subsidiaries. That means we have a company in the US, we have a company in Germany, and we have a company in Japan. So these subsidiaries are, for example, Japan has broken even. Our Europe office has broken even. The US is making a small loss, but it's not significant. The big one has been the subsidiary which was based in India doing the EPC business. And that I would say last year is the last year where we will have such kind of significant losses coming in from there. Everything has been closed right now. So the company no longer functions, and there are just 2 people left in that organization, and we have cleared all the debtors, creditors, everything has been brought down to zero. So as I said, it's over.
So you reckon FY19 would be the last year of whatever little pain is left?
No, FY18 it's finished.
Okay, all done and dusted. So FY19 onwards, it's a clean slate. Okay.
A clean slate.
Okay, cool. So now talk about how is business looking as well, and just to juxtapose that question, if I look at what you've done for the year on a top line which is nearly about, on a consolidated basis, about 450 odd crores, if I'm not wrong, you just about scratching to making some money. Can that change if you up the revenues by 50 to 100 to 150 crores, and will we see evidence of that in FY19? So 2 questions rolled into one. How is business looking, and then some numbers around FY19?
So the business situation has been improving for us. I don't think that there's going to be a step jump or a dramatic change in the business conditions which will give us, as you said, 150 crores of additional business, because that will represent something like 25 to 30% or 35% growth. Those conditions don't exist in the market, even though we have the capacity and capability of delivering those numbers in terms of production capacity. The markets worldwide still are very depressed for power generation. There's overcapacity, but there has been, I would say, for TDPS internationally at least, the price war in the market has actually been benefiting us, because we come in with a low-cost, high-quality product from India, and a lot of customers have turned their attention to our product, and we have got a lot of orders internationally recently to support our business plan for the current year. Domestically, there is definitely a revival in the large captive power plant business. When I say large captive power plants, I mean 10 megawatt to maybe 40 or 50 megawatt. There has been a revival. We are seeing an increased, slow but steady increase in the incoming orders. And, it's too early to say whether this is a sustainable thing and whether investments are really picking up in the country, which will give it, there's some kind of sustainability, and one can predict numbers going into the future, especially since we also have the general elections around the corner next year. And then that will again affect the investment climate in the country. So there is a certain amount of holdback, which we are seeing in the market right now. But there are pockets of investment taking place which are going to benefit the business plan this year. Also, spot power prices, if you have been keeping track, spot power prices have shot up dramatically on the exchanges to something like 8 rupees, sometimes even 11 rupees or 12 rupees. So once again, captive power plants are back in favor. So people who need power on, let's say, 20 megawatt, 30 megawatt for a process plant or a cement plant, many of them earlier were looking at alternatives, but now it's just back to standard coal-fired captive power plants, which is going to really give our business a big boost. And I don't see this underlying, I would say, underlying issue or changing in the next 2 or 3 years for the demand supply for captive units for electricity. So they will be dependent on machines that.
Right. So Nikhil,
so I think that it's going to be good, but it's going to be nothing dramatic.
No. So then let me ask you. I mean, is it possible for you to predict that you would have an X percentage growth in your top line in FY19, or for that matter, in the next 2 years?
I have an earnings call with the market in an hour from now, and I will be giving guidance during that call, but I can also give it right now. So I am giving a guidance on the low end. I'm saying that we will do high single-digit growth, and we have 2 or 3 large opportunities where if we have a little bit of luck, we can get into high teens in terms of growth. Now, when I say luck, I mean that we are well positioned. If those projects actually come through or actually get operational, we will get those orders. But there's also been so much of uncertainty and so much of fluctuations in the market over the past 3 or 4 years that I hesitate to give a commitment based on that, because sometimes projects have a lot of potential. People talk about it and we are expecting it to come in the last moment for reasons not known to us. They just get cancelled or postponed indefinitely. So as I said, low end will be high single digits, maybe 8-9% growth. And if we are lucky, if those 2-3 projects really come in, then we will be high upper teens.
Okay, so we wish you all the best for you to be able to get all of those, Nikhil. That will only augur well for you as a company and for your shareholders. One final question and a quick thought there. What's the current order book that you're sitting at? What's the kind of inflow that you envisage in FY19?
Current order book that we have, including the large order that we have for the railway business, is 1,050 crores, and but what will be executable in this? What will be executable in this current year will be something like 415 to 425. So this is for the manufacturing business, and then we have approximately about 75 to 80 crores coming out of the projects business. So we are looking at something like, as I said, 500 crores, which will be representing something like 10% growth over 450 crores that we have this year. As I said, high single digits. That's the worst case situation.
Yeah, well, we hope for the best case situation for you, Nikhil. Thank you so much for joining us today and giving us that perspective, and all the best for FY19. That's TD Power Systems pointing towards maybe an 8-9% growth as the base case. It's been an okay kind of a quarter, but you know, the bigger movement is happening in the aviation space. Look at Jet Airways today. It's just gone off the cliff completely. Just bring that stock up 9% lower now at 383 for a stock which is already corrected over 50% YTD. And that's not all. Some of the others too have come off. Let's try and figure out, what does somebody who's tracking this space do in a scenario like this? Whether or not there is merit in looking at the companies which are growing arguably very well, but are facing headwinds from crude and some of the others. Let's get an innovation expert and an equity analyst at Stewart and McCartish Wealth Management, Sarthak Mukherjee. He joins us right now on the show. Sarthak, good having you. Thanks so much for joining in. You know, month after month, the numbers keep on coming in. Actually, let me first ask you about Jet Airways, then we'll get to the sector at large. What did you make of the numbers? What did you make of the auditor's qualification on Jet Airways?
See, as they have mentioned that they have already reported a loss, mainly due to crude oil rise and depreciation of INR. Although we have seen a lot of things happening in the sector, we have seen that the oil price going up, we have INR depreciating, all the airlines are reporting poor numbers, the share prices are having a free fall. However, the growth is still visible because the month-on-month air traffic growth, you see, it is above 20% on a year-on-year basis. If you consider from 2008 to 2017, there is a CAGR of 9.89% in the domestic aviation sector, and international passenger had a CAGR of around 8% in the same period. So I think this is a temporary phenomena. Oil above $80 is temporary. In the long run, I think that crude prices will come down to 70-72 levels.
Well, Sathak, I mean, so, that's anybody's guess, right? I mean, I take on board your point that you're working or making your calculations with that in mind. What if what you're envisaging doesn't happen and crude continues to rise? Morgan Stanley, for example, is saying by 2020 crude could hit 90. For the near term, if all the comments are to be believed, the cool-off will not be immediate. If crude prices stay at the levels that they are until the Aramco IPO or say for the next 6 months, what does it do to the numbers and consequently to the return ratios and therefore the financials and the multiples for some of these aviation companies?
See, the FY19, the results will be poor. There will be hit on the margins. The profitability will have a downward pressure, but investors generally discount future. So we see a lot of potential in the sector, and ultimately with the huge amount of growth and the government trying to give some push, initiating new ways to increase the increase the volume of passengers, I think that definitely FY19 will experience some hit in the margins, but in the long run, it will definitely give investors value for money.
So, okay, how are you viewing this? Let's work. I mean, one is the assumptions that people make for the calculations. The others is based on those assumptions, whether the companies are available at valuations or at a value which is worth investing in. Jet Airways has corrected northwards of 50% from the in YTD. Indigo, I believe, about 25 to 35 odd percent, whatever the case may be. SpiceJet, similar levels as well. Where do you find value within these three? And is there I mean, what's the pecking order? Assuming that you like all the three, what's the pecking order then?
See, as I was saying, that the growth that the industry is seeing is immense. If you see, there is RCS, Regional Connectivity Scheme, that is UDAN. We have seen that the most of the growth is fueled by Tier 2 cities. So Tier 2 cities like Ranchi, Bhubaneswar, they are having 90% growth in volume of passengers. So see the demand and supply scenario in the sector is positive for the airlines, because the rate at which the infrastructure is coming up or growing will not be able to keep pace with the passenger growth. And moreover, there is huge expansion plan by the airlines. In fact, SpiceJet has ordered around 205 aircrafts, Boeing 737, and they will be, I think, operational by end of August or September.
Okay, so then again, my question then therefore would be that what stock would you like to buy? While we've seen very good capacity utilization or PLFs, as the case may be, prices haven't done anything meaningful. If they raise prices, then the PLFs would come off. Maybe that's a desirable thing as well. But based on all the permutations and combinations that you have, what stock from these three is an ideal purchase, either now or at better valuations?
See, if you see that in India we see around 12 crore passengers being carried per year by the airlines, and compared to around 12 crores by the AC coaches in railways. So this is a secular trend. We are seeing that the airlines are outpacing the railways in great numbers, and moreover, recently, a couple of days back, the government Civil Aviation Ministry has come out with some proposals regarding customer experience. So that will only cater to the volume growth in the industry. So I think SpiceJet and Indigo both would be a great bet, being being corrected so much.
Sathak, we'll leave it at that. Thank you so much for taking the time out though and joining us and giving us your logic on why do you believe some of the aviation stocks might be a good bet. The key noticeable thing is none of the people that we speak to talk about Jet Airways as being a bet despite the fact that it's corrected quite a bit. Well, to add fuel to fire, they are talking about not being averse to looking at Air India. That alone should spell doomsday from an equity investor's perspective for Jet Airways. So no doubt that the stock is under pressure. The markets, though, cooled off a little bit, not under pressure, but cooled off from the highs of the day. The Nifty is lying absolutely flat now. In fact, dipped into the red for a brief moment as well. So it's turning out to be a day as we expected it to. Let's hope that the pressure is not too immense at the broader end of the spectrum during the course of the session. It's a wrap on this leg of Indian Open. Thanks so much for watching. Up next is the FNO Show.